Hi, good afternoon, all. Friends, you must be hearing, or as I look through the program, there are lots of sessions which are there on, what are the big opportunities over next 5 years, 10 years, big themes, and you will get lots of insights. And I think, I'm extremely bullish on India. In my career of 25 years, I have never seen what kind of time today, and I'm sure you will get similar flavor from lots of other speakers. The reason I chose the topic which I chose today, which it has helped us to build perspective with lots of investors who struggle to make. I mean, you hear bullish view all the time from everyone, right? But how do you sort of make investment decisions? Because in investing, more than returns, we believe risk management is very, very important. Anybody can make returns, but very few can retain, and that is very, very critical. And what it takes, this effort is to build that perspective within the investor. I mean, lots of sort of investment gurus have said, like I said, that essence of investment management is management of risks, not management of returns. Retention of returns is very, very important than anything else. And as Charlie Munger said, and this statement took me many years to understand, but once I understood, I think it really stuck. That invert always invert. Tell me where I will not die, I will die. I won't go there. And if you understand essence of this, I think you can be sorted rest of your life. So I would invite you to kind of delve on in this later as you sort of think through. Very often investors are worried about, we get these questions, should I invest into market? Will it correct? What level should I invest? What sectors should I invest? And all the time we see, we get these questions from the people, is it too overvalued? And partly I think we see fear in the investors throughout, partly created by the short-term movement in the marketplaces, media created partly, I would say, short-termism in investing. So we thought, let us build this perspective that how to look at investing. And the way we look at in investing, there are three kinds of risks. And once you understand essence of these three risks, you will be able to understand how to handle this. Type A risk, which is the risk of permanent loss of capital, meaning after you have invested, you have lost between 50 to 100% of your capital. That's the type A risk. Very, very important risk. And one has to manage this, right? Because that safety of capital is very, very important. Now, what is the source of this risk? It comes from only broadly 2 or 3 sources. When you invest into poor quality of the management or in businesses which are prone to disruption, right? Now, this risk is highly controllable, manageable, and I will talk more about it. Type B risk is the risk of volatility, meaning after you have invested, stock price goes down, and which all the time happens, right? All of you must be relating. Every time I buy, stock has gone down, right? It happens to me all the time, right? Now, that risk can come from any time, from any source. It comes from very, very different sources, from a political reason, geopolitical reason, natural calamity. We saw pandemic happened, right? It can come from monetary policy related, anything, anything happens around the world. It can happen because of the rumors. This risk is extremely uncontrollable. You cannot control this risk. But most of the time, investors are trying to manage this risk or worry about this risk, right? This risk remains same whether you are 10,000 of Nifty, 15,000 of Nifty, 20,000 of Nifty, right? So, again, this is the second risk. And third risk is the risk of opportunity loss, meaning you should have invested into asset class A, sector A, stock A, but you invested into B, stock B, sector B, asset class, thereby generating suboptimal return, right? The source of this risk is twofold. One is lack of knowledge, that we don't know what's happening, where the things are going, where the ball is moving, right? Where should we invest? And second is long-held biases. We all have long-held biases around, I have, you have, all of us have those biases, and they prevent us from getting a optimal investment many times. And I'll talk a little bit more about them as I delve deeper. Right? So just a little bit talking, in detail about, type A risk. So, like I said, that 2 sources. When you put into inferior quality of management, can you control this? Yes, by doing a lot of work, study. This is very, very manageable. People who spend little bit time understanding business, understanding balance sheet, doing a little bit of work, they can figure out that this management quality does not sound pretty, good, and you can avoid. So once you avoid that, you are actually taking, care of a lot of risk on that. Now, we did some study to showcase that what this risk, and same thing I was saying that businesses which are prone to disruption. So we know that broadly which are the risks, businesses which are going, possible disruption, the risk is very high. If you constantly keep your eye on that, you will be able to avoid this risk. I mean, we have seen many examples, whether it is MTNL and many examples, in front of us where businesses over the years have got wiped out. And today also there are many which are prone to disruption. I mean, we at Carnelian clearly believe that if you think there is little bit risk, be very careful, don't look at them, or at least even if you're looking at them, put them in the high risk bucket. So you are consciously aware that this risk is prone to risk, disruption risk, and you are taking a particular risk on that. Just little bit, study we did. Because of type A risk, just to put number in context, 32 lakh crores have been lost over the years, right? Which is almost 2x the size of, current equity MFAUM. This is the extent of loss of capital which has happened because of many companies which at one point in time, 3 lakh crore market cap, 4 lakh crore market cap, today don't even exist. This is the kind of wealth loss which has happened because of this risk. And it almost close to 12% of the current equity market cap. And if you have any such stock in your portfolio, one stock out of 10 stock portfolio, your 10% of the capital is wiped out. To recover that back, you need a multi-bagger. So it is very boring to sometimes to say that, invest into good quality management, invest into good businesses, but this is what it ends up doing. So if you can avoid permanent loss of capital, it's in my opinion, again, a very big addition to your alpha, addition to your, money saved is money earned in this sense. So we do a lot of work in terms of avoiding this risk in our, and this is, by the way, highly controllable, highly manageable. It is not that, you can't control through knowledge, through hard work, through study. You can definitely control. There is nothing, and accidents can always happen, but this is manageable. Type B risk, again, you cannot control. It is impossible to control. It is futile to control. Yes, of course, if you are a leverage player, you must worry about it. If you are a short-term trader, you must worry about it. And that's not the category I am referring to. That's not at least what we do. So hence we don't worry about this. But this is again, risk which, in my opinion, 80% of the time, most investors spend worrying about this risk. Whereas actually 80% of your time you should spend thinking about type A and type C risk. It's just inverse in terms of how much time and energy we spend on the risk. Now, just give you some data points. Can you guess a company which, despite having corrected 17 times 10% in a day, 8 times 25% in 3 months time, and 40% drawdown in 6 months period time, has delivered 45% CAGR? Now 45% CAGR. Now it's very, when stock is good, if you remain invested, now as high quality company as Kotak Mahindra also has seen 40% drawdown. So if you get worried about the intermittent risk, volatility risk, drawdowns in between, you will always end up giving away a very high quality company from your portfolio. So if you are a long-term investor, it does not matter that, as long as you are convinced about the quality of the business, quality of the management, long-term growth prospect of the company, it does not matter whether, it corrects 10%, 20%. Of course, you have more money, buy more, otherwise just sit tight. And that is, and like this, there are many examples. It's not only Tata Consultancy has seen, similar kind of, 40% drawdown, 25% drawdown 3 times. I mean, it has consistently seen like that many companies. Bajaj Finance, which is again, has seen 40% drawdown twice, which has delivered 45% CAGR. Sri Cement has seen all the companies, and this is usual in market. It is usual in market. Because when market goes down for many reasons, whether you are a good company, bad company, everybody goes down. Good companies will probably go down a little lesser, bad companies will go down more. But everybody has to go down. This is the nature of the market. So according to us, it is futile and to spend time on this particular risk. Coming to type C risk of opportunity loss. Again, this is the one risk I feel most people don't even realize that they are taking this risk because of the, again, reasons I spoke about. One is biases we are holding all along. If you have, and I'm not going to kind of talk in detail about biases because biases is a very long subject. One can kind of spend hours and hours about talking about. But when one is aware about some of these biases, one can keep on fighting, looking at what's happening. You must have heard many times, it happens to all the time to us that, if you bought a particular sort of stock and, what you own in your portfolio, it is very hard even if you realize that this is a wrong stock, to get out and switch into something else. It is very, 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 very hard. And especially, I have seen investors, if you bought a stock at, let's say, 100 rupees, and if it has gone down to 80 rupees, people keep on waiting indefinitely for it to get to 100 rupees to get into switch out something else, because I don't want to book loss. This is a very, I hear from accomplished investors, average investors all the time. But at 80 rupees, if you are finding something else which is better, which can double faster than it getting back to 100 rupees, it is better to switch out and move out, right? But these are the biases which help us to constantly move into, which kind of prevents us from moving into, even if we realize that we are in a wrong investment, to switch into something which is even better, right? And these biases, I can tell you, very hard to fight. It is not easy. I myself have gone through, I still go through, all of us go through this. But when you are acutely aware about it, constantly watching out yourself, you can really, sort of fight. And same thing, I think, there are many biases, whether it is anchoring bias, recency bias. Recency bias is, typically we believe that what has happened recently will continue to happen. If market has fallen, we'll get scared and we will kind of not allocate more capital. Or if markets are going up, then we will allocate capital, right? There's no reason why SIP flow should keep on increasing only after the markets have gone up 40-50%. Ideally, it should have been other way around, right? But it does not happen, because human psychology is to believe that what has recently happened will continue to happen. And these are the biases. If we constantly fight, I think, one can come out well from, these biases. And second reason for opportunity to see this is lack of knowledge. Many people, invest into markets without and investing, as we all know, this is about futuristic, what's happening, where the ball is going to be, where the opportunity is going to be, which are the futuristic things, right? Because that's where you have to be. So it requires huge amount of knowledge, understanding, reading, keeping track of trends, interacting with people. And if you are not up to it, you will obviously end up, if you get into a good opportunity, at best it will be by fluke, not by it will not be probably consistent. You will not be able to find consistently, ideas, opportunities where the future opportunities are. Last year, I remember when, post-pandemic, when we launched our strategy shift, which is basically once in my opinion, lifetime shift happening in India post-pandemic on manufacturing and IT services. I can tell you, we hit our head against wall. People believed that manufacturing in India cannot pick up. And today, 1 year down the line, we have seen how things have changed, in a significant way. Now conviction is still coming in, but it's still not fully there, right? So I think it requires a lot of connecting dots, a lot of reading, a lot of, preparation. And once you are, I think, sort of up to it, in my opinion, you can manage this risk also. And, and we have seen, accomplished investors like, we have heard Warren Buffett, right? Who for 10 years kept on refusing that I don't invest into technology. So it's not that only a common man, suffers from this, or you keep on denying sort of certain, so idea is to avoid this risk. If you spend your time in, most of your time in, type A and type B risk, I think you can come out very, very well. It's futile to spend time on type B risk. And if you spend time on type B risk, then I think you should ask this question. It's not market which has stolen your return. It is you who has stolen your return. And I think I'm up with my time, so I won't take much. Thank you very much.